Hey guys, what's up? How's it going? My name is Rob and welcome back once again. And in today's video, we're going to focus on top 5 monthly dividend ETFs that hold Canadian stocks. So that's going to be the main theme of today's video. I know a lot of you guys like monthly dividends. I'm a big fan of monthly dividends too, because that's really what inspired me to get started with investing. You know, it was the idea of earning passive income, having that money grow over time, and then, I could work less, or I could maybe one day live off my dividend income. And that's what really got me started. Now, when it comes to dividend stocks, Canada has a lot of good solid dividend stocks, and they have some pretty good ETFs too, but there's some things you want to look out for. And in today's video, we're going to focus on the basics and the fundamentals. I'm going to try my best to explain to you guys in the easiest way possible some things you want to look at, some things you want to look for, some things you want to pay attention to when you're buying ETFs. But this is going to be really basic, it's going to be really easy, and it's going to be perfect for beginners. So if you're somebody who's just getting started or you're not too sure what to look for when you're looking at an ETF, we're going to cover all that in today's video. So if you guys enjoyed this video, please give it a big thumbs up. It really helps me out. And remember to subscribe if you guys want to see more content. So let's jump inside the video. Let's take a peek. And here's the top 5 Canadian monthly dividend ETFs that I think you guys should look at. Alright guys, so the first monthly dividend ETF that we're going to be taking a quick little peek at here is ZDV, and I'm on the website here for the Bank of Montreal, and this is a fund owned by them. This is the BMO Canadian Dividend ETF, again, ticker is ZDV, and this portfolio is a monthly dividend portfolio that is designed to provide exposure to a yield-weighted portfolio of Canadian dividend-paying stocks. The fund utilizes dividend growth rate over the past 3 years and payout ratio and dividend yield to invest in Canadian equities. So it's basically just kind of your run-of-the-mill basic Canadian dividend monthly portfolio. And the benefits here of the portfolio, as they say here, is designed for investors looking for income and growth solutions, exposure to higher dividend paying Canadian equities, for anybody who wants sustainable income with lower volatility than the market, and it's managed by BMO and whatnot. So here's the website you guys can take a peek at if you want. I'm going to actually just download the fact sheet here pretty quickly because it's going to tell us a lot of bit of information about the stock. And if you go to a lot of ETFs, a lot of time these websites, if you just punch them into Google, you can find like this information, and I will link to all these pages in this video, so you guys can get in the description of this video, so you guys can kind of see this information for yourself. So here's some basic information of the fund sheet, and let's kind of look at some basics here that we want to take a peek at here when you're assessing ETFs. And I'm going to go through all of these things with the different ETFs. I'll focus and do this a little bit slower for the first one so you guys can just kind of see here, but I'm going to zoom in a bit so hopefully you guys can see everything. So the first thing we're going to look at is the distribution yield. So the distribution yield of this fund, if we go to down the bottom where it says fund characteristics, we're looking for the annual distribution yield. This would be the dividend yield. So if you invest in this ETF right now, you're getting a 4.18, which is a little bit over 4% dividend yield that is going to be paid out on a monthly basis. Now that's a pretty good yield. That's definitely a little bit on the higher side, like they mentioned when we looked at the information about the fund. So that's the first thing we're going to take a quick peek at. So if you're looking for passive sustainable income, that's definitely on the higher side. This fund definitely might be something to check out. The next thing I always like to look at is the holdings of the portfolio. So let's take a quick little peek at the holdings here. So once again, these little sheets here, or if you can find some information on websites, it's always nicely you can find nice ones like this. It definitely makes it a lot easier. So you can see the sector allocations is 40% financials, and whenever we're dealing with like high dividend stocks, or like I would say some of the better quality dividend stocks, I know a lot of them are kind of in the same field, and obviously that's not the best if you're looking for long-term diversification. But I mean, I honestly think that a lot of the best Canadian dividend stocks are in the financial field. And then we have energy stocks, some utilities, some communications services, and then we have some other ones here at the bottom, which is a little bit of everything. So this fund isn't super diversified, but it does have a little bit of diversification, with about less than half being financials, and then energy, utilities, communications taking up the rest, and then some other ones here at the bottom. So it's not too bad. Again, if you're going to use this fund as your only Canadian fund, it definitely would be perfectly okay, and I'd say that'd be good. If we look on the holdings here on the side, we can see the stock names. So Bank of Nova Scotia, RBC, TD, obviously the top 3 banks. You're going to see that with a lot of these ETFs. They all hold the big banks because they're just good, solid dividend stocks. Like they really are some of the best stocks in Canada, in my opinion. And you can see the allocation weights. That'd be 5% of the portfolio is in Bank of Nova Scotia, 5% is in Royal Bank, little under 5% in Toronto, and so forth and so forth. And all these stocks here at the top are all, I would say, good quality stocks. I hold a lot of these in my main portfolio. So nothing really out of the ordinary here. And you can like look on the fund sheet or look on the website to see the other holdings as well. Now, the next thing I want to talk about really quickly is the fees for the fund, because this is something that a lot of beginners overlook or they might not understand, and it's really simple to understand here. So fees are usually would be here in the detail section. We can see that the annual management fee is 0.35%. Now, the management expense ratio is going to tell you the full total of the fee at the end of the day. So your total fee for this portfolio is going to be 0.39%. which is going to be the total. So that's 0.4% roughly that you're going to be paying on an annual basis for the fund. Now, again, this is baked into the price of the fund. You don't have to do nothing. It won't get taken out of your account. It'll just be automatically factored into the NAV price, so you don't have to do anything. So 0.4% isn't a horrible management expense ratio. Is actually pretty affordable. You will find some that are a little bit less and a little bit more. I would say anything under 0.5 is pretty good. Once you start hitting like that 1% range, it's definitely a little bit on the higher side, but nonetheless, it's important to look at the overall return of the fund to get a better idea of if it's worth it, at the end of the day. And the last thing we want to look at when it comes to funds like these is, I think the most important thing, once you kind of assess the holdings, the fees and whatnot, is to look at the actual growth of the portfolio. So once again, there's going to be this little graph here, and usually it's like in some type of performance category or something like that, or return or something like that. And you can see that they have a little risk rating of about medium. And I would say that's pretty good. This would be like a medium risk ETF. It's pretty basic, but it also has a lot of room for growth, as you're going to see here. So here's the overall price over the past month, a plus of 3.9%, over the past 3 months, 12%, 6 months, 17%, and yada, yada, yada. So the main thing we're looking for is the long-term growth of the ETF. Now, the longer the ETF has been around for, the better it's going to give you an idea what the return is going to be. So if we look at the 1-year return, we see that this ETF gained a return of 40% in the past year. And this is obviously because of the pandemic and whatnot. We've seen a big recovery. Over the past 3 years, on an annual basis, this fund has given us a 9% return, which is pretty good. Over the past 5 years, once again, 8.4%. And if we look at since its inception, which is basically telling us from the year that this fund started, on an annual basis, you can expect a return of around 7% if we were to kind of average it out. And this is what you're looking at. So 7% of an annual return on average is pretty decent. I would say it's pretty good. It's definitely not like the highest, but again, keep in mind, like, last year was a very poor year for stocks. So that's going to push that down. So once again, if this area, or if you're dealing with a new fund, you can always look at the holdings individually to get an idea of kind of what to expect for a return. You can look at these individual stocks kind of thing and kind of be like, okay, well, Bank of Nova Scotia is the biggest holding. What kind of return do they have? And that'll give you a good idea. Just make sure you're focusing on the ones with the higher holding percentages, as that's going to give you the more return at the end of the day. So overall, my recommendation for this fund is, I think this fund is a pretty good solid fund, especially for beginners. If you're looking for like a nice, good Canadian dividend ETF that pays monthly, that's really easy, has low fee, and is really going to give you a good return in the long run. And like I said, does pay that monthly dividend yield. Definitely take a peek at ZDV. I think this is probably a really good fund. It's actually better than I thought it would be after taking a peek at. So this is definitely one you might want to look at. All right, so the next fund we're going to be taking a peek at is going to be CDZ, and we're switching gears a bit here, and we're taking a peek at iShares. So iShares is a company by BlackRock that holds a lot of ETFs. It's a good company. They hold a lot of good ETFs. We're going to take a peek at this fund, and I'll show you guys their homepage and kind of how to assess this ETF, because you're going to get different kind of setups here, and we're just going to show you guys how to take a peek. So the ticker for this ETF, once again, is CDZ. This is at the top, and you guys can see the price here is $31 Canadian. And here on BlackRock, we have a little information about the fund. So this is diversified exposure to a portfolio of high quality Canadian dividend companies. Underlying index screens for large established companies that increase ordinary cash dividends every year for at least 5 consecutive years. So looking at companies that are good quality companies that have a dividend that they're increasing for at least the past 5 years, and they earn regular monthly dividend income, and that's what this fund will give you. And the objective for this investment fund is to replicate the S&P TSX Canadian Dividend Aristocrats Index with less fees and expenses. So that's what we're going to take a peek at in this portfolio. So once again, here's the performance tab of iShares, and we'll cover this first since it's the first thing on the page. So this is going to be the overall return of the fund once again. So average annual we can see here. So total return over the past year is 44%. Once again, this is expected because we've seen a big rebound. So most of these funds are going to have a really high return over the past year. Over the past 3 years, annual return average is 11%, 5 years is 8%, 10 years is 7.5, and since inception is 7%. Once again, kind of close to that 7% range we've seen with the last fund. If we go cumulative, we can see the total return added up. So if you were to kind of just keep adding it together, this is what you'd give your return. So after 10 years, you'd have a return of 106%. And since inception, you would have a total return of 175%. I mean, you can look at this if you guys want, but I really don't pay attention to this too much. I kind of like the average one because it just gives you a better idea. And then we can also go to calendar year and see the overall return for each individual year. So, you know, this will give you a better idea. If you guys don't check the calendar year return, this opens your eyes up to the fact that every single year is vastly different with stocks. You know, in 2016, we see a return of 21%. That's a lot different than a return of 5%, and then a return of negative 8%, and then a rebound of 25%. So just understand that average is just the average. It's not the actual return. You're going to get big years and kind of lower years, and that's just how the stock market works. 2020 was a low year, so we should see a bit of a rebound for 2021, specifically with Canadian stocks. So just kind of keep an eye out for that, and that's how you can kind of predict how things go with the stock market to some degree. Down here we have the distributions, which you can click this chart, and this will give you an idea of the monthly dividends. So you see September, October, yada yada, pretty much the same thing, and it shows you the actual dividend. I like the table view because we can see the payable date. It's just easier to read the month, how much cash it is, the total distribution, and then that's pretty much it. So that's kind of what you need to look for there. And going down here, here's some more facts about the fund. So number of holdings is 86 holdings, so I think it's larger than the other fund. I didn't actually check the number of holdings and the ZDV, but you guys can take a peek if you want. That's something I accidentally forgot, so I apologize about that. And here's some more information about the fund. So distribution yield, which would be your dividend yield, is 3.27%. So actually almost 1% less than ZDV. So this would give you a lower dividend yield. There's also some other information like the payout, the price to earnings ratio, drip price, and some other things. And once again, distribution frequency is monthly. That's what we're looking for and whatnot. Anything else here isn't super important that we really need to look at. We're kind of looking at fees here. So fees are interesting because the fees for this one is much higher than the previous one. We can see if you have 0.66%. Once again, this is like the main fee. This is going to be the total fee you want to look at. So I think the previous one was what, 30% or 40%, I think it was. So this one's a little bit higher, but once again, it's pretty low for the most part. 0.66% is pretty low. But if you can get a lower one, it always helps you out because remember, you're losing 0.66% yearly, and you know that can add up over time. And here's the holdings. You can see the top 7. You can go all-time holdings. And one thing I really do like about iShares is their website is super easy to read. It's super easy to read. It's super easy to make sense of. And I do like the way they lay out information. So if we go to the top 10 holdings, this one is going to be interesting. We can see a bit of a deviation from the previous ETF. This one's more focused on some other ones. So we have some energy sector. We have real estate. Smart Centers is the second largest holding. So that's kind of surprising. We have Pembina Pipeline. That's a pretty popular long-term Canadian stock. We have Enbridge, once again, Canadian Natural Resources, Power Corp, Fire, I think, Capital Corp. I've never actually heard of that stock. That's a new one for me. Great West Lifeco, Canadian Imperial Bank. So the actual first bank we have here isn't until the top 9th holding, and that's only 2%. So it looks like this fund is a lot more broader, a lot more diversified, and has a little bit of an equal holding of everything inside of it, as the fund percentage holdings are a little bit closer together than the other one. And here's a cool little sector thing. So once again, it is predominantly financials, as that's going to be the case with most of these funds, but we can see a little bit more emphasis on energy, industrials, more real estate, more utilities, and then some other things. So this has a lot more, if you're looking for one that has more diversification across a lot of different stocks in Canada, this would be more for you. But again, it just depends on your objective goals at the end of the day and what kind of stocks you like. So always take a peek at the holdings because it does make a big difference. And overall, at the end of the day, I do think this fund is pretty solid. Once again, it's got good growth, it's got a good return, and if you look at the underlying assets, they're pretty solid, and the fees are not too crazy. It's pretty decent, so I'd say this fund is definitely, once again, another option for you guys if you guys want to look for a monthly Canadian dividend fund. So the third fund we're going to talk about is VDY, as I just previously mentioned. VDY is actually the fund I hold inside my Canadian portfolio. So if you guys follow my channel, you know I am a big investor of VDY. I like this fund, so I'm not going to be biased in all honesty. In fact, I'll kind of give you guys my opinion on why I like this fund. And at the end of the day, like all these funds I kind of cover for the most part are good funds and I would recommend them. So don't feel too torn about them. I think for the most part, they're all pretty good. So VDY, once again, is a Vanguard-based fund. So this is a different provider. And forgive me, guys, if they really did change their website recently. So I'm sorry if if I miss things or if I have trouble finding things because they completely changed their layout. They seem to do that a lot. We'll take a peek at the fact sheet because maybe this will give us some more information about things in a nice little sheet where we can read. So once again, here's the fact sheet. It looks like they made this for May 31st, so pretty recent. Ticker symbol is VDY, traded in Canadian as most of these ones are. Let's take a peek here to see some of the things we want to look for. So just really quickly, we'll go over the objective of the fund. So this fund seeks to track to the extent reasonably possible and before fees and expenses, the performance of a broad Canadian equity index that measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. Currently, this Vanguard ETF seeks to track the Canadian High Dividend Yield Index or any successor and invest primarily in common stocks of Canadian companies that pay dividends. So once again, it's your pretty run-of-the-mill basic ETF, but there are some differences as we will cover specifically in the fees and the holdings. So I'm just going to scroll down really quickly here to show you guys the dividend yield. For some reason they have it at the bottom here and they kind of have it weird, but this is equity yield is going to be the dividend yield that we're looking for, and that's a 4.3%. So once again, it's on that higher side. It's not like the previous one you looked at, which was around 3%. It's actually 4.3, and I think this is actually the highest yield so far. And keep in mind, this yield is done at the time that this fact sheet was published, which was last month. So that will change on a regular basis depending on how the stock price goes. So the next thing we want to look at is the holdings for the portfolio. Actually, it's on the same page here. So we can see sectors here, and this is where this one really changes from some of the other ETFs. We have a 60% holdings in financials. And once again, this is going to be what's going to happen. And this is why I kind of prefer this fund. I like the financial companies. I think they're really good. I do believe it's important to diversify your funds and your stocks. And I do that in my portfolio. But once again, this ETF, I think some of the best Canadian stocks are in financials. So 60% is quite a bit. And then we have energy. So predominantly we're looking at energy and financials in this ETF. Then some telecommunications, some utilities, and some very, very little of the other things, if not non-existent at all. And the number of stocks is 40. So it's a pretty small ETF. And I would use this as a supplemental ETF. So if you're investing in some other main ETF, or let's say you're looking at something that's more broader based or international or US based, this would kind of be a nice one for Canadian stocks, or like a supplemental ETF to hold inside your portfolio, but it's up to you guys how you guys want to do that. So the top 10 holdings are Royal Bank of Canada, TD. Look at the big differences between these top holdings. RBC is 14% of the portfolio, which is once again quite a bit. TD is 12%, and then we go down quite a bit here to the Bank of Nova Scotia. So top three banks hold about, if you want to look at 26, 30%, over 30% of the portfolio. Then we have Enbridge, Bank of Montreal, CIBC, TC Energy Corp, Manulife, and then some other ones here. But this fund really does focus on the finances and the bank stocks, which I think are really good stocks. So that's why I like this fund, and that's one of the reasons why I picked it. The next thing we want to look at is the fees, once again, because I think that's important. And I think the fees were up here somewhere at the top. Yep, we can see the fees here at the top here. The overall fee for this fund is the lowest we've seen so far at 0.2%. That's super low. And for a Vanguard fund, oddly enough, this is actually high. So this is the lowest fee fund, and that's another reason why I like it. So you pay the other fund we just talked about. CDZ had a fee fund of about 60%? This one is 40%. It's 2 times less, or I guess the other fund is 3 times more, or 2 times more. Yeah, 3 times more than VDY. So the fee, once again, we're talking about pretty low fees for all these funds, but again, that does add up at the end of the day, so it's something to always watch. And if we look at the growth of the portfolio, which once again is like kind of the more important thing to kind of watch for, we can see that this fund has some of the best growth over the past couple years. And once again, a lot of that is coming from these bank stocks. So the past 3 months, it's up 14%. Year to date, it's up 22. 1 year up 43, 3 years 11%, 5 years 10%, and then since inception, that's an average return of 9.3%. So once again, this has kind of been higher, but again, this fund is relatively new. It's only been around for I think about 6 or 7 years or something like that. So over time, that will probably go down a little bit. But you know what? It's because we have so many banks with this fund that is performed quite well. And once again, this is the fund I hold. But at the end of the day, I think all these funds are great. It's really up to you guys on which funds you want to put inside your portfolio. All right, so as we're getting towards the end of the video, we're on the 4th ETF we're going to take a peek at. And I'm sorry if these videos are getting kind of long. I'm going to try and speed through these now that we've talked about some of the basic things to look at. The next one we're going to talk about is XEI. This is the iShares, once again, another iShares fund, Composite High Dividend Index ETF. So this says, once again, the ticker is XEI. Current price is $24 Canadian. And what is this fund? It pays monthly dividend income. It's low cost, and it's designed to be a long-term foundational holding. And it seeks long-term capital growth by replicating the performance of the S&P TSX Composite High Dividend Index. So that kind of gives you guys an idea of the performance of this fund. So let's look at the yield to start, and this is going to be somewhere at the bottom here. So we can see the yield of this portfolio is currently 3.79%. So 3.79% is kind of like, it's still pretty high at the end of the day. It's kind of in the middle. It's not the lowest one we've got, I think, but it's also not the highest. It's kind of like in the middle there, almost at that 4% or just underneath. And the next thing we're going to look at is the holdings once again to kind of give an idea of what stocks are inside this ETF. And the holdings are, once again, we've seen a little bit of difference between some of these ETFs. So it's interesting. Whoops, I don't know why that happened. It's interesting when you look at these ETFs and you look at the holdings to see like kind of where the different weights are. Like, so a lot of the stocks are the same. Some of them are, some of them aren't, but the holdings and the weight percentages are really different. So it's always worth to check the holdings. We have Enbridge, Canadian Natural Resources, Royal Bank of Canada, TD, Suncor, Bell, TC Energy, Bank of Nova Scotia, and then Nutrin, which is another stock, and then Bank of Montreal. So once again, a lot of the same stocks, some of them with a few differences slapped in here and there with different weightings. And the weightings are pretty consistent for most of these funds. And the actual sectors, and I think this one is probably one of the most diversified funds, I think. If we look at this, so 30% financials, 30% energy. So this is more of an energy and financials fund with a little bit of communication, a little bit of utilities, and then some materials and real estate. You'll see it once again. You see that trend of low real estate, low materials, and kind of utilities are kind of in the middle. That's just because that's the kind of stocks that Canada holds, unfortunately. But we do have good finance stocks, which we do have going for us. So that's the holdings for the fund. And the fees, they mentioned that the fees are probably the best thing about this fund. We can see a low fee of 0.22% as the maximum fee. So once again, that's pretty low. That's about kind of on par with the Vanguard fund. Kind of once again, the super low fee fund. So once again, the holdings though are probably the most important thing to take a peek at. So the holdings and the growth, So the growth here, if you scroll back up, we can see the actual growth. So average annual return as of, looks like it's been around since 2011. So it is a long-term fund. And we can change this, so we can go like 2016, no change here, 2013, and we can see yada, yada, yada. So once again, you want long-term if possible. Whoops. Just to see kind of the different differences between the different years and whatnot. But over the last 1 year, once again, pretty good growth at 44%. Last 3 years, 9.74%, 5 years, 8%, 10 years, 6%, and then inception about 7%. So 6.58, which is probably the lowest I think so far. But once again, this is a longest term fund, so you're gonna get more of a, I would say, a better example of how Canadian stocks have performed over the long term. And once again, you can take a peek at the yearly return. 2016, 28, 2017, 7, 2018, negative 10, 2019, 25, and then 2020, negative 7. And keep in mind, like if a stock ETF has large holdings of one stock, like let's look at a holding here that's not in the other one. So Suncor. If Suncor did really horrible, which I believe it has over the past couple of years, that's going to push down a lot of this return. So keep in mind, the individual larger holdings really do make a difference on how the funds will perform. Same with Enbridge. All right, so the last fund we're going to look at is going to be probably the most interesting one, and the one I see a lot here on YouTube. A lot of people talk about these covered call ETFs. And once again, I'm not an expert on these ETFs. I'm just going to kind of give you guys a rundown, a really basic rundown of how they work. But most importantly, we're going to look at the returns, because this one does things a lot different than the other ones. You're not just buying stocks, you're buying covered calls. So this is ZWC by Bank of Montreal. And this is a high dividend covered call ETF. And as you can see, it is really high dividend. So let's take a peek at the strategy here. So the strategy is designed to provide exposure to dividend-focused portfolio while earning call option premiums. The underlying portfolio is yield-weighted and broadly diversified across sectors. The fund utilizes a rules-based methodology that considers dividend growth rate, yield, and payout ratio. Securities will also be subject to a liquidity screen process. And the ETF also dynamically write covered calls options. So this ETF will sell stocks on a regular basis. And the call options are written out of the money and selected based on analyzing the options available premium. So once again, I'm not super knowledgeable with covered calls. In fact, I've stayed away from them, and I'm going to show you guys why that is. But there might be some benefits to these ETFs depending on what you're looking for. But they do come with a word of caution. So designed for investors looking for higher income from equity portfolios, basically designed for people who want like high monthly yields, as you're going to see. And they're invested in a diversified portfolio of high dividend Canadian companies. Call option writing reduces volatility, apparently. I don't know if that's true or not, but like it does seem to be true. And is once again managed by BMO. So let's look at the fund sheet. Let's take a peek at some things, and we're going to compare this fund to some of the other funds that we have here. So first thing we want to look at is going to be the yield. And once again, this distribution frequency is monthly like all the other ETFs. So look at this yield, annualized distribution yield of 7%. This is almost double the highest yield we got from the other ETFs, which was around 4%. So almost double. So that's pretty crazy, right? So super high yield on a monthly basis. So anybody who's looking for, a high dividend yield might look at this fund. But here's the kicker, and we're gonna look at this in a second here, okay? So the first thing we'll look at is the holdings. Okay, the holdings are pretty diversified, I'd say. It's almost the same as some of the other ETFs we've seen here, right? Like Royal Bank of Canada, Bank of Nova Scotia, CIBC, Enbridge, Toronto Bank. These are just good quality stocks. In fact, I'll invest in a lot of these myself. You can see pretty broad sector. Once again, mostly focused on financials, but a little bit of everything in here. But the big thing, we're gonna look at the fees here really quickly here. So the fee is gonna be, I think, on the highest side. Let me just take a quick peek here to see if I can find it. Management expense ratio is 0.72%. So this is actually the largest fee-based fund. You're almost paying 1% in terms of fees. So once again, it's not crazy, but 0.72% is a lot more than 0.2 or 0.5 or even 0.6, not by much, but it is a little bit on the higher side. So that's something to keep in mind, which is also something I don't like, or I prefer some other ETFs, but it's not a game breaker at the end of the day. But the biggest thing we look at is the growth. So let's take a peek at the growth of this fund. So they say this is a medium risk fund. Now let's look at this fund. Now this fund is a new fund. It's only been around, I think, for a couple years. So once again, it's hard to really say the data and this is why I'm kind of like, it's kind of a bit of a question with some of these covered call ETFs because they just haven't been around long enough to compare the returns. But we can see here that over the last year, they went up 32%, which the market did. Over the past 3 years, it's up annually 5%, which is a little bit on the lower side. And since inception, the return is 4.86%. So that's a little bit on the lower side, but keep in mind, we're looking at a smaller period of time. So let's compare this to the other ETFs we talked about. So I'm on a cool little website here that's called Simply Wall Street. It's a cool little website to compare some information, and I like the fact that you can see overall returns of ETFs over time. And you can include things like compounding interest and whatnot. So over the past year, ZWC has a return of 26%, which looks pretty attractive, right? And this is just stock appreciation. So stock appreciation just by itself, no dividends. Now, obviously, we expect this fund to perform a little bit less because it doesn't have much stock appreciation. But over the past year, 26% growth. Over the past 3 years, negative 6%. And if you flip over to VDY, which we're comparing it to, over the past year, VDY is up 43%. And the past 3 years is 21%. And the past 5 years is 40%, just with stock growth. So when you're looking for a dividend fund that's long-term, I really want to encourage you guys to be careful with covered calls because long-term, they're not showing us that they're actually a good investment, especially if you're looking to compound and grow those earnings over time. So once we slap on the include dividends returns, we'll go back to ZWC, we can see that the return goes up. So if you're investing back into the fund, this is what this is assuming, then your 1 year return would be 36%. That's not bad, it's better. but the 3-year return is only 16.7%. That's still pretty bad for 3 years. If we look at VDY and we include dividend returns, which would be if you reinvested those dividends, we have a 1-year return of 50% almost, and then a 3-year return of 38%. So 38% compared to 16%, that's a big difference. So when you're looking at these covered calls, if you're looking for growth, if you're looking for longevity, if you're looking for a portfolio that's going to grow over time and you're going to live off of, be careful with these covered calls, because even though they have good high dividend yields, right now it's showing that they're not necessarily making long-term growth inside your portfolio. So once again, I'm not an expert. I'm not going to say not to buy them. Just kind of be aware of that if you're just buying individual stocks, so far it looks like they're performing better and they're the more safer bet. But once again, it's up to you guys how you want to do this. And let me know what you guys think of covered calls in the comments of this video, because I know a lot of people like them, a lot of people talk about them, and I'm not super knowledgeable. So if I'm missing something, or if you guys want to let me know, just feel free to let me know in the comments. But this is my comparison of the two ETFs. Alright, so that's it for today's video, guys. I hope you guys enjoyed it. Let me know what you guys think in the comments. And like usual, if you guys did enjoy it, give it a big thumbs up. It really helps out the channel. Take care. Have yourself a good weekend. I'll see you guys later, and have a good one.